Okay, welcome to the WT3 podcast, the podcast where we tell you, emerging tech founders, what to do. Today, we have the episode on understanding the intricacies of valuing your company and products and maximizing your startup valuation at the front end. We've got Sebastian Spitzer. I'm going to read a little bit of an introduction. So, Sebastian, welcome to the podcast. Thanks for being with us today. A little bit of background on Sebastian. He's a venture specialist at Schaeffler's corporate venture capital arm. With a rich history in automotive, construction, and electronics industries, Sebastian has spearheaded multiple in-house startups, applying agile innovation and lean startup methodologies. His career highlights include creating transformative business concepts, leading to major internal exits, and he's deeply involved in emerging technologies such as AI, blockchain, and robotics. Notable companies include DuckDAO, the Morpheus Network, and CV Labs. Beyond his corporate achievements, Sebastian is an active mentor and investor in the venture capital scene, shaping the future of tech with his forward-thinking approach. Join us as we delve into Sebastian's insights on innovation and venture capital in today's tech landscape. So thank you for being here with us today, Seb. How are you doing?
Pleasure. I'm doing good. Thanks for the amazing intro. Always makes me blush when people read out stuff like
You're
that.
More than welcome. You're more than welcome.
Well, we're certainly glad to have you here, man.
Yeah. And this is one of those questions where everyone gets super hyped, and it's like, everyone's always talking about raising money. They're always saying, like, I need to raise. My priority right now is raising. Every startup founder we talk to is like, yeah, if I could only raise more money. So for me, this episode is pivotal, and genuinely something that people want to know the general answers to. I think let's start at the beginning. Is the best place to start. So, how did you get into emerging technology?
Yeah, so maybe for full context then. So I started my career in marketing and then quickly ventured into product management and innovation management. And that was actually the inflection point. And now we're talking about like 15 years ago-ish. So I always loved lean startup principles and design thinking. It always felt for me that is the right approach to work on products and innovation. Also, if you're working in a big corporate, so not only if you're a startup founder, but also if you're working in an established company. And that just felt like it was my world, right? So ever since, I've always driven projects and new product launches like they were in-house startups, meaning, be lean, be mean, move quick and break things. And that just felt natural to me. And that's also how I ended up being in emerging technology. So I think the big switch came about 8-9 years ago when I was in the automotive industry. So my job there was basically building up an internal unit that worked specifically like an entrepreneur unit, like internal startups. And we were tasked to look into mid to long-term technological enablers, right? So not like the immediate stuff, but things that were like 3 years out or more, and actually like drive innovation in that field. And back then that was like a wild mix of everything, which was really fascinating because it allowed you to dive deep into new technologies, different verticals, and just learn a lot in a very short time. And that namely those were back then like blockchain. That was 2017, so blockchain was on everyone's mind. Also in the enterprise segment, so how could you use it for the automotive industry? How could you use it to secure supply chains and all of that? It was additive manufacturing, 3D printing. Also back then, self-driving cars was a big hot topic that was before it sort of became normal. I mean, we're still not there yet, right? So there's still some infancy issues, some teething problems when it comes to fully autonomous driving, as Waymo and others have shown recently. But that was also like a big top of mind thing back then, like visual computing, sensor fusion, all of that. And of course, AI before AI was cool. So mainly like visual computing in factory settings and manufacturing for quality inspection, or also visual computing object recognition for self-driving cars. So a lot of that already was AI back then in the automotive industry. So those were exemplary fields that I looked into. And that's also why I stayed there, right? Because we had a lot of like instances where we didn't have the competences in house. So we were also actively looking for startups and founders that could work with us as technology partners. So that was ultimately what allowed me to really immerse deeply into startup ecosystems. And yeah, I've stayed in those fields ever since.
What was your first startup ecosystem in either AI? I'm guessing it was blockchain. What was your first one you got like kind of sunk into and rabbit holed in and didn't come out a couple of years later?
Yeah, it actually was blockchain, funny enough. So now we're talking like 2016, 2017. And back then we were, there was like automotive industry, right? So we were exploring enterprise use cases, mainly like supply chain application or securing vehicle identity and repair and maintenance records attached to a specific vehicle on the blockchain to basically create a more transparent used car market and repair market. So those were like some use cases we were exploring back then. And while after half a year of like deep diving and like really like scavenging the entire market and looking at solution providers, the result, unfortunately, back then was it was just not enterprise ready, right? The scalability was not there. The tech wasn't mature enough to really be deployed at scale. A lot has changed since then, but basically after half a year of deep diving into solutions, speaking with founders and looking at the market, I came back and said like, yeah, there is interesting concepts, but it doesn't feel like it's really ready yet. But I stayed there in my spare time. So basically just, splurged more on my own dime.
So but you didn't answer the question. Which one was it? Because I'm actually interested because I know you for about 4 years. I'm actually curious which chain you kind of got involved with first, because I know there's a number of chains you've been involved in, but which one was the first?
Yeah, back then it was Ethereum. I think like, that was like ICO mania and like tons of like new projects being launched in Ethereum, and like the whole market was in a frenzy. And it's also funny to look at that retrospectively because there is a lot of resemblance with AI right now.
Yep.
Feels like 2017 all over again, baby.
Oh yeah.
Yeah.
Mostly the Gen AI space. It's insane. It's like including all the rebrands of all the experts that within a year are now AI experts, right? Yeah. But Sebastian, like, we've talked about this quite a lot also, off screen, obviously, and coming in 2017, like, as you said, the industry was completely different. You did this aside to stay. What was that defining moment for you? Say like, hey, shit, I really like this. I want to do something more with this. And then I think also at some point, like, you also made that switch to kind of corporate venture capital. But there were, I think, a couple of defining moments where you're like, hey, I like this space. I want to stay here. And I want to do something more with that than just, fuck around and find out.
Yeah, you're absolutely right. And I think, so for me, it was about crypto's biggest strength, which is also its biggest weakness, and that is community. So I was fascinated by how closely knit that ecosystem was and how strong the community was, right? It's almost like tribalist. So you have these different chains, and then you have like the maxis of different chains, and it's almost like political parties, right? You can't like both, or you sort of have to decide which side you're taking, which is a bit stupid, and I think it softened up a little bit now. People are acknowledging that different networks, different infrastructures come with different advantages and disadvantages, and it's more like an open-minded field right now. But still, it's largely tribalist, community-driven, and then hype-driven, which that's why I'm saying it's also one of its biggest weaknesses, because some of the things that are happening don't really help with building credibility and trust in the wider public space.
Mm-hmm.
So I think that's also something that the whole Web3 culture and ecosystem still have to work on. It's like, if you really want to have mass adoption, there has to be some sort of like regulation. There has to be some sort of like self-control, right? If you're mostly known for scams and basically like flushing money down the toilet and then basically like hype-driven meme coins that literally say they have no value and utility, and people still pump them up to like over $1 billion market cap. I mean, things like that, if outsiders look at it, they're like, oh, okay, wow, that seems to be like really trustworthy. Let me trust those companies with my life savings, right? That's unfortunately not how it works. And it's interesting because I just literally looked through something that Sequoia Capital recently posted, which was like a product market fit framework, and they categorized new solutions and startups in 3 categories. Hair is on fire, right? Like crowded market, everyone wants it, everyone's aware of the problem.
Yep.
The other one is like a hard, I think they call it like hard fact, which means everyone acknowledges that there is a problem, but people have just gotten used to live with it, so they don't really, they've arranged themselves with the status quo, so you sort of like have to change habits. And the other one is like future vision, which is like, what the iPhone was back then, or what Elon Musk did with Tesla back then, before anyone was really realizing that there is a needed market. And why I'm saying this is, I think Web3 at large is still at this sort of hard fact place, right? Because we know that a lot of things in the financial system are broken, especially when you also look at data economy. There is a lot of things that could be improved, but people sort of have arranged themselves with it, right? Like we all using banks. We have come to acceptance with the fact that data is basically a good that we can exchange and trade for services, like let's say Google Maps, and we don't really need to explore how to monetize it, for example, right? So there's a lot of like value promises that crypto has that are great, but it's tough to change habitual feelings and accustomed like usage of things. And if you want to do that, you have to create trust, right? And then that's like what I'm saying. It's like one of the biggest weaknesses that the market has, and I wish that would change, because it probably would for the better for everyone.
Yeah, no, and the question is when it will change and how it will change, right? Like I think that's always like this is the ongoing discussion that I think we have had now in different different discussions with our different interviewees. I would say everybody kind of acknowledges this point, right? So to that point, Sebastian, I mean, like you're now like you have shifted heavily to corporate venture capital, and I think in the sense like to term sheets, you're writing a lot about that too. Why did you specifically move in that direction, and what makes this specific direction so interesting? And I know you've been advising companies as well in the past, and I think you're still doing that. Was that part of that move, that the interest kind of shifted towards more corporate venture, or did that came from Schaeffler? Where did that start, and where is that currently? Because like you're still very deep in it, right?
Yeah, I think the investing bug got me when I actually immersed into Web3, and that was like after the crazy bull run of 2017, right? So it wasn't like, oh my god, I have to FOMO in. There might have been a little bit of that. I won't like deny that. That might have not been like a little factor there. Better than me. But hey, I stayed interested throughout the depth of the bear market. So there is that. But that's when I initially started. So I just loved the process of like looking at startups, like really like going in, doing the due diligence, and like speaking with founders, like getting a feel if the founder is the right person for the startup, if the team is basically has what it takes to take something to success. And I started my investment journey in Web3, right? So I helped DuckDAO like evaluate deals, and I basically helped them with their scouting network and basically manage the deal flow with them. And that was like my first touch point into venture capital, or like investing in startups, both as an angel and like in a VC kind of manner. And I built up on that. So basically what I did, and maybe this is also useful advice for anyone who's looking to venture into that field, I built up on that. I built up my network. I built like the relationships and the trust within a specific vertical. And then I also like, took some educational classes with Oxford, for example. There's other vendors out there as well. And like really educated myself about venture financing, like the typical terms, the things you have to know if you want to go in that field. And when we moved to the US last year, I solidified that, helping Schaeffler with their venture efforts. So right now we're not like deploying as a purebred fund. It's still deploying off balance sheet. But it's basically that the great thing about that is it's more of a strategic angle, right? So it basically incorporates all three options. We can either partner with a startup and like work with them and do projects together. We could just become a client of their solution if it's mature enough, or we can invest in them. Like a couple of investments that we did over the last 2 years were like, for example, an H2 green steel. So that was like steel is one of the main components of our products. That was like a late stage ticket, relatively sizable. And then there was like 2 minority investments, for example, in like robotics and software companies at an early stage. And the great thing is, it allows you to really look into fields that are not that heavily discussed in public opinion, like industrial, deep tech, robotics.
I was going to say, it's a lot of deep tech.
Humanoids, exactly, like applications that are maybe not on top of mind for the everyday user. But in my humble opinion, those will create the backbone for the next industrial revolution if you look at it from a manufacturing and production standpoint.
That's a big. I want to explore that one later, by the way, because that's a really interesting. Because you're talking about what, Industry 4.0 or maybe even 5.0, kind of like
You mean like Web 5.0? Or
Web 5.0. Yeah. We had a couple of very spicy takes from our co-hosts saying that like AI is Web 3 now, and Web 4 might be like AI and blockchain as the infrastructure. Yeah, like we'll see who's right. So, but to your point, like, you've been working and educating yourself. Are there, like, over the last couple of years, what did you think, if you look specifically at Web3 and blockchain, like, are there things in a term sheet that you've seen that were absolutely bonkers or were absolutely great, and things you kind of like, are very common that everybody should do, and it's crazy if you won't?
Yeah, I think the most outlandish part of most Web3 term sheets is usually the valuation. I mean,
true.
So there are a couple of elements that are sort of like most of the time is not even included in Web3 term sheets. So like not a lot of, especially if it's token based, right? So maybe a quick disclaimer, or just throwing some words out there. So term sheet, I don't know if everyone knows what that is, who's listening. So basically it's what you get to sign as a startup founder when you work with a venture capitalist. So it's basically the terms of the investment. And there is a lot of provisions, usually either around the economics of the deal or the control of the startup later on. And some potential side provisions that could be like in side letters or formulated into the term sheet. But basically, it's like your contract that you sign between investor and the startup. And a lot of provisions, for example, hover around like anti-dilution rights, like the kind of shares that you're getting, like is it preferred shares, is it like normal shares? What happens with the distribution of liquidity when you get into an exit, right? Like then it's like the preference, for example, liquidity preparation. Or like, how is the board assembled? What happens in the next round? Like, do you have any like drag-along, tag-alongs, stuff like that? But I briefly had a discussion with Charlie about that earlier, so we're not going to like go crazy into detail and all of these things. What we will do, we will actually write some blog posts about it and some LinkedIn posts later on over the next couple of weeks. And anyone who's really interested in learning more about that, please just follow and like, digest that and consume that, because it just burst the frame here to really go into the detailed metrics. But when it comes to Web3, usually the Web3 term sheets for most parts are not even that sophisticated compared to like real equity investments, right? And reason being, and sort of makes sense, especially if a token is involved. I mean, if you're talking about a token-based investment, since you have token generation events, and since you have like immediate access to liquidity as soon as the token launches through DeFi or centralized exchanges, there is some aspects that you have to consider in a normal venture capital deal that just don't apply to a token-based startup. Like, example, you invest in like a pre-seed seed company, right? Like normal startup, equity-based. Which usually means that unless you can sell your shares, whatever you bought at that point, as secondaries down the path, you have to wait until that company either gets sold or goes public and is traded as a stock before you can do anything with your investment.
Yeah, you
right?
need that liquidity event. The paper turns into real utility that you can then translate to whatever it is you want to use.
Exactly. And with tokens, usually that time frame is a lot shorter because that liquidity event, if you get an early stage, that might be 5, 7, 10 years out. Now, with most token-based companies, usually the liquidity event is like 1 year out or 2 years out, which also has one of the intricacies of Web3 deals where usually you put vesting schemes and cliffs on the investors and not on the founders. Well, the founders have it too, don't get me wrong, but usually in traditional venture capital, it's like the founders are vested, right? So they you want to secure that they don't leave their company early on, that they like stay at it for the next 3 to 4 years, exactly for the reasons that we just mentioned. Whereas in Web3, usually the investors get vesting, right? Like, so you basically, your tokens are locked for the next 2 years so that you basically don't dump your investment as soon as it goes on the market. So that is one of the key differences, which coming back to your question now, there is sometimes really outlandish and extremely weird provisions that some founders try to enforce. And luckily, the investment market in Web3 also has matured quite a bit over the last couple of years. So you have a bit more experienced investors that actually call founders out on their bluffs. And the power dynamics are a bit different, right? Because back then, like when you had a hyped up project similar to what is happening in Gen AI right now in the real world, so to speak, the valuations that were asked for were astronomically high. Like we're talking about 30 million, 50 million or more valuations at like a seed, like pre-seed sometimes, right? Without a product in the market, without any form of real traction, which is absolutely ridiculous. And people paid that price, which usually didn't end that well in the next bear market when the tokens finally unlocked, basically.
It didn't even end well in the next bull because by then generally they were already dead, right?
Or
the founders ran.
Or that.
Or actually, not even that. Like, even if your company survives and you've overvalued, like you've asked for too high a valuation and you need a follow-on round, you've just hamstrung yourself. So let's say hype cycle, you've then got your next level of the business, which is like, okay, I've pre-seeded or seeded at a ridiculous valuation. I've then got to go back to the well because I'm a technology business and that first round of funding is to build the thing. Now I've got to sell it and actually grow it. No one's going to invest at that valuation because the amount of the company that they're getting for the value of the money that they're giving you doesn't add up. Like they're not going to make that deal. That's the biggest trap that I've seen people with value highly fall into.
100%. And like, if you're a startup founder and you want to stay at this for a couple of years, right? You should. There's two things that should matter to you. One, don't get over diluted, right? Like, don't sell away too much of your company at an early stage, because if you have to stay at it for the next 5 or 10 years, just think of the psychological effect that it might have on you if you already have given, like, let's say 70% of your company away after year 2 or 3. How motivated will you really be to see this through for the next 10 years?
Exactly.
So that's one thing. But on the other end of the spectrum, exactly as you said, Charlie, like shooting for the stars early on, well, you better make damn sure that you actually can deliver and follow on that, because if you can't, if you ask for crazy high valuations at, like, let's say a pre-seed stage, it's going to be tough to keep that momentum up potentially, meaning you might be forced to like raise a down round afterwards. And that is like, it's not a death blow per se, but let's just say it doesn't have the highest appeal, right? Like it's definitely not.
It doesn't feel
your
good.
narrative, right?
Yeah. It doesn't feel good. I completely agree.
No.
So in the interest of time, we're moving forward to advice to startup founders. This is a section where we have pre-prepared and community sourced 10 questions for our venture expert, Sebastian. As we proceed into this next segment, I do ask that you like, subscribe, and hit that bell button. It always helps us. And as we're doing this to educate and elevate, I really appreciate it. So first question, Sebastian, now I know we've transitioned very nicely into understanding term sheets. If we're going to dial this down, like for our core audience, we're really trying to give that 0 to 1 experience, that practical application. What are the most critical component, like your bare bones basics, like literally the terms to put into Google that you need to search for new founders that often get overlooked? So I mean, starting off at like type of share, preferred versus common, or any other kind of piece. Like what else that our new startup founder audience needs to understand? Like what should they be looking out for to start their learning journey? And then are there any gotchas that you've seen?
Yeah, I think let's break it down and make it easy. So if you're starting your journey, one, educate yourself about the type of investments, like the money pools that you can tap into. Most likely you will start with family and friends and angel investors. With that being said, educate yourself about the vehicles you can use to raise money, right? As you said, so there is a couple of provisions in term sheets, but even one stage above that is, what are we actually using to raise money? In general terms, you can go venture capital route, you can go into like syndicated deals, or you can go into crowdfunding, which is like the ICO, or like the pre-sales in the crypto space, basically. But in general terms, if you're like at the start of your startup career at ground zero, most likely your first vehicle will be a SAFE or a SAFT. SAFE is like standard agreement for future equity, and the crypto equivalent for that is the same with T at the end, which is tokens instead of equity. Now, what's happening in the crypto space, and you should also be aware of that as a founder, is that usually, that we've seen more and more crypto companies going into equity fundraisers as well, and then basically offering token warrants. So the purebred token sale just proportionally decreased over the last couple of years, and like investors also ask more and more for equity because it gives you a bit of a different leverage over the company, because now you can ask for a board seat and you can exert control, which you can't if you hold tokens, because quite frankly, tokens don't give you any control over the company. It's also something we will touch upon in a second. So first, educate yourself about sources of money and the different vehicles that you can use to actually obtain money. So that's number one.
You might wanna explain what a warrant is, because I think that a lot of our listeners, at least I remember a while ago that I was looking at it for the first time and I was like, a warrant? What does that even mean? So maybe it's good to explain that as well. Why sometimes a SAFT comes with a warrant, a SAFE comes with a warrant.
Yeah, so basically what that means is you have sort of like a side provision that you entitle your investors to also receive tokens for their money. So at the time of investment, they receive equity in your company, meaning they get shares. They own a part of your actual incorporation of your legal entity. But when you do release a token down the line, they are also entitled to receive that token. And now it depends how you put it in there. Now we are going really deep into the term sheet. It could be pro rata. It could be that they have to purchase those tokens again at a specific price. So now you really have to like define the conditions and agreements that you put in there. But in general terms, it means it entitles your investors to any tokens you might issue in the future based on the provisions you outline in the term sheet.
Perfect.
Okay. And so to Charlie's point, to round that up, so once you understood which vehicle you're using, note on that, SAFE or like convertible notes usually are sort of quote unquote like they convert into shares. That's why they're called convertibles. SAFE kind of is that as well. It's like a promise for future equity, but both of those at the beginning are not equity per se. They convert into equity as soon as you have a first price round. And then price round is exactly where you distribute shares of your company. There's different types of shares, preferred shares, normal shares, basically. So educate yourself about what does that mean? What are different kinds of shares? Educate yourself about participation rights in preferred shares. Educate yourself about an option pool. I think that is especially important if you really want to grow your company, because usually you have stock option pools for your employees, which means as you most likely can't pay your employees as well as a Google, an Apple, or one of the hyperscalers can. So meaning you give lower salary, but you give them equity in the company as an additional contribution. You should educate yourself about board rights, like board representation, and like how investors can control your company, and what it means if you have an investor as part of your advisory board, or like part of your company, board of directors. You should educate yourself about vesting, about drag-alongs, or any like additional consent rights that investors might get. And lastly, like warrants, as we just said, educate yourself about those, how to structure them, how to use them. And I think that covers it all. The good thing is, so what we will do, promise that to Charlie, we will write over time and like explain all of those things in more detail. There is a great resource that was published by HSBC, for example, that we can refer to, that pretty much covers it all. Because bottom line, what you should know, there is a spectrum for all of these things. And usually there is, on one side, an extremely founder-friendly spectrum, similar to valuations. The higher the valuation, the more friendly, quote-unquote, it is to the founder, because you're giving away less of your company. And then on the other hand, there is investor-friendly provisions and terms, which usually come to fruition when we have a tougher market like we had the last 2 years in venture capital. That usually means that the power dynamics shift from founders to investors, and investors can dictate, more harsh terms. But reality is, as a founder, you just have to be aware what you're negotiating about, right? If you are absolutely clueless and go into a negotiation, there is a high chance that the negotiation will not end in your favor.
Yeah. I think that's a very nice way of putting bent over a barrel. Anyone seen Pulp Fiction? That.
Yeah.
Right?
Yeah. Yes.
Well said.
So
this is especially important for first-time founders.
It really is, and I think that you've just summarized that really well. Like type of stock, type of equity, how the options work. I mean, it's interesting. You mentioned this earlier. What was the wackiest set of special provisions have you ever seen put into a term sheet? This is my own personal interest. Like I've seen one where one guy's like, I want a Nando's black card. So Nando's is like a chicken shop in the UK. And you can buy these. Like you have to call them and be like, I'm going to give you 100 grand or something dumb. But they just get free chicken for life. Like this is something I've seen put in. What have you seen put in?
So honestly, the biggest red flags that I've seen were usually around valuations, and like basically, and that is all, now we're talking crypto, right? And like founders trying to impose completely weird provisions about vesting schemes and exclusive rights to them versus the investors. Yeah. Like just as an example, right? Like basically allowing the team to liquidate the tokens. So that was like a pure token fundraise, allowing the team to liquidate the tokens within the first 2 years, and the investors have vesting over 5 years, right? Like it's like I'm like, okay, so what does that tell me about your own confidence in your company, that you basically want to have a provision where you are allowed to sell off everything that you own within 2 years, and I have to wait 5 years until I can sell?
But I've seen people signing that shit. That's the craziest thing. Yeah, really? Absolutely. I mean, like a bull run, was it 3 years ago, like 2021? Oh, people signed all kinds of things. I was like, ooh, like Sebastian, I think you and I have seen some stuff come out. I was like, well, maybe not. Like not none of this. It does happen. No, wild, but yeah.
Question 2. This is the next question from the audience, from the community. It's valuation. How, like, again, practically, how should a startup founder approach the valuation process with potential investors? Obviously, get your own legal team. But beyond that bit,
speak to David.
Yeah, particularly in early stages, pre-revenue phases, pre-revenue numbers, like you've done your friends and family, and guideline friends and family, if it's a lot of money, 10 to 20%. I mean, I usually stick to 10 is my recommendation. And also you've then got people on your side who are interested. For your pre-seed, if we were going to give we've said you don't want to go into your Series A rounds with less than 30% of your company. If someone owns, if the investors own 70%, you're not going to be very motivated. If you're going into your Series A, I'd say 60%. But this pre-seed phase, you've done your friends and family, you're about to do your first venture capital raise piece. What advice would you give?
So I would definitely recommend do some research. Well, that sounds dumb, but you wouldn't believe how many founders, in the beginning of the journey, just won't even bother spending a day looking on Google. And sometimes it's not even their fault, because the VC industry is a bit obscure and blurry, and it's a private market. So obviously not all the information is publicly available. It's not the stock market, sure. But these days, there is a lot of people on LinkedIn, but also on other media and forums doing a great job of creating transparency and giving founders the means to educate themselves. So quite frankly, if you are serious about this, you're a founder, there is actually no more excuse to not spend some time and educate yourself and have some basic understanding of where the market is at. A good source, by the way, I can throw that out there, is Peter from Carter. He's very active on LinkedIn, and basically just go on carter.com. No, this is, by the way, I'm not getting paid for mentioning this, but he just really puts out, he puts great overviews and statistics based on the US market. Yep. For the European market, Deal Room is good. They have some very good comparables for European-based investments. And couple of things that you should bear in mind when you're approaching this first is look at comparable valuations, see what the valuation range is for your specific round. Let's say pre-seed. Usually right now we're talking about 5 to 15. I know that's a broad range. It more hovers around 7.5 right now. So if you really have to be Gen AI and 4 founders from Ivy League elite unis with X Google, X Meta, X whatever tags to call for a 15 million round. But let's say if you're just average founder, normal founder, you usually get into a 7 to maybe 10 million bracket, or a 5 to 7, depending on your unique dynamics around the company. Whereas if you go into seed, right now we're talking about somewhere around from 10 million to maybe 25. Also broad range, I know, but there is really a lot of factors in play that influence what you can actually ask for. But those are just some hallmark numbers. And here's the thing. Those also depend on your vertical, right? So not every vertical has the same brackets and range. And that's why I'm saying do some research, right? And I mean, obviously I'm not Wikipedia myself, so I also do research, and it's part of the job to keep informed, to stay informed about where the market is moving, because the valuation ranges also change over time, right? So as I said, right now it's an investor-friendly market, so valuations tend to be on the lower side. Whereas if we go into a full-blown hype and bull market and stocks are flourishing again, maybe we are more on the far right side of the spectrum. But you just have to know that, and you have to keep abreast, and it's also part of your duty as a founder to have a general understanding and keep updated about the market dynamics if you're raising money. If you're a solopreneur, if you're bootstrapping, none of that has to matter to you. Sure, if you don't even want to raise money, power to you, kudos to you. I really have deepest respect for that. Then you may be getting away with not educating yourself about that. But if you intend to go the venture capital round and raise money from outside investors, it is actually your duty to at least have a minimum degree of knowledge of what you're trying to do here. Also to protect yourself, right? It's like in your own best interest to have that knowledge. And I think, so those valuation ranges that I just gave, those are important. You brought up a very good point with dilution. So what does that mean? Usually at the beginning, pre-seed seed, you should aim to stay under 20% dilution. So ideally, when you get out of your seed, you still have 60% or more of your company. The more, the better, because at that point, usually what kicks in is then you also have to have the stock option pool for your hires. So that's usually like 10, 15% or more, depending on your specific structure of the cap table. So
just
that
to
means
quantify
at that point,
60%.
you're already...
Sorry, that 60% is the founding team, right?
Exactly.
Not
exactly.
just
60%. Yep.
one person.
or one person. Exactly. Yeah. Founding team or one person. Exactly. Yep. So basically what I'm saying is when you reach Series A, ideally you want to shoot for still having the majority shareholdership of your company. And that's also what VCs will look at. Just to give you an interesting example, practical example, how a cap table can be messed up. We see that a lot in deep tech when it's about university spinouts. So especially European universities are notoriously bad and horrible at making their spinouts investable for venture capital. Like a lot of universities, and I'm looking towards the UK, but also Germany, like to retain 20, 25, 30%, or sometimes even more of equity in a spin-out startup. That is horrible if you want to go on the venture capital route. Like it makes it really unsexy to invest in startups like that. And these days, there's definitely better ways to doing it. But moral of the story is, be aware of your dilution, manage your cap table, learn some basics about cap table management, or get an advisor, get a friend, get a contact that can help you with that.
Absolutely.
Learn about the state of the venture market so that you at least know if you're asking for a lot or maybe if you're asking too little, just also to protect yourself. And just learn some basic terms and terminologies to protect yourself and to make sure that you're not getting the short end of the stick.
Yeah. To add to that, I would also recommend a book called Venture Deals, especially super useful with trying to learn those terms. And for the price of 15 quid, and depends how quickly you read, a couple of days, you will get those terms. You will, especially US based, mind you, where you will understand the general terms, the terminology, and where those experts have seen people get into situations, how they've had to get them out. It's a phenomenal resource that completely opened my eyes to the game as well. I mean, following on from that, question 3, and this is a big one. I mean, big one, which is equity distribution. We've got a founder team. I mean, our thesis here at WT3 is hacker, hustler, hipster. That's that term coined by the Silicon Valley startup market. Your standard 3-man startup team. What do you go even splitsies? Like, how do you who do you give more equity to? How does it work? And how common is it for you to see an uneven split amongst startup founders?
I didn't prepare that answer, so I don't have specific percentages, but I can remember that I've seen statistics on the US market like recently, and funny enough, and this was surprising to me as well, usually you see uneven splits. Like uneven splits are more common than even splits, actually. Yeah. Which might make sense, right? Like if you think about the dynamics, how it usually works. So you either have some high school friends that do something together. There you might see more of an even split. But then other dynamics are you have like let's say a technical founder who researched something and already developed something as a breakthrough thing, and now needs someone with business expertise and the CEO kind of type. Then you would maybe argue that the CTO or like the technical co-founder already brought in more. So why would you give the same to the business guy? And vice versa, it could be if a business guy like myself. So I can code with GPT. Like I can basically like instruct large language models to do what I want them to do, which is a blessing for me, by the way. But and I have a fair understanding of coding and how software works, and I've been leading software projects. But I'm not a software engineer, right? So that means if I were to found a company, I would need a technical equivalent that can help me with the coding. Which also, by the way, that is another thing, very important tip for all founders. So if you are like me, or maybe like Charlie and Thomas, I don't know about your software engineering skills, but if you are not a dedicated software engineer with like 10, 15 years of experience, so you're in the same boat like me.
Yeah.
If you have a software idea, if you want to build a digital product, get a technical co-founder. Like if this is your first reality check. If you can't convince another person to join your cause and be the technical co-founder, maybe your idea is shit, or you're lacking a vital skill of convincing other people, which, especially if you're the business guy, that's actually really bad, because you will not only have to convince that guy, you will have to convince all your customers and investors down the line. So if you already fail at convincing your co-founder, then you might want to stop at that point and find a new idea, quite frankly. So that's another thing. But let's just say you have a scenario where one of us has a business idea, and we already put in a lot of time researching. So we have the network, so we have the distribution advantage, right? We know our target market. We can basically immediately approach a couple of customers there. We've done our entire research over months. We know exactly how to position it, how to price it. We already have the entire business concept. And now we just need someone to build this specific product that we already completely envisioned. Then you might argue it's actually fairer if you bring on a technical co-founder, that a technical co-founder might receive a bit less, because that other person already went in there and did all the front loading and like already spent like months or years of his time doing this. So I think it really depends on your unique situation, but long story short, it's actually more frequent to see an uneven split than an even split.
Fascinating. That's super interesting. It's something that I've been looking into a lot recently, and I agree. So, for first-time founders, if you're all starting, so it's time, right? It's amount of investments, or economist terms. So the cost of the opportunity foregone, like the opportunity cost. Like I've already put in this amount, 6 months into this project. Now I'm going to bring someone aboard to help me realize it, but that 6 months cost money. Cost me the opportunity of doing something else. If you're all starting together at the same time doing the same thing, even is what I've seen the general consensus being. But as you say, whoever started first gets more, and I think that's fair. It makes a lot of sense. With this next question is a doozy, and we've asked pretty much every financially orientated guest the same question, so we're getting our own consensus from already the community. How do you get in touch with VCs without being bloody annoying? Like,
or with being bloody annoying, but still get actually the contact, right? Because that might sometimes just be the case.
You're essentially, well, the business metaphor is you're essentially getting into bed with these people. You're going to be talking, like, ideally the business goes well. You'll be dependent on the VC funds. The time horizon in Web3 is 3 years, but 3 to 5. That's a relationship, right? Like you've got to not walk up and piss them off as a first impression.
Little fun fact for trivia night: the average startup founder investor relationship lasts longer than the average marriage. So just keep that in mind.
That's great.
At least in the US, maybe the US is a bit more trigger happy with divorces. I mean, it probably would make a lot of lawyers around here happy, but anyways, that's a different story. No, but you're absolutely right. Like, ideally, your investor is like sort of like a buddy, mentor, advisor, and has your success in their best interest, because they invest money in you. So it should be a mutually beneficial relationship. And how to find them is, well, here is where it gets a bit weird. So if you look at social media, usually people post success stories on social media, right? It's like all great. It's like, this amazing unicorn world. We are all living in paradise world. It's all happy. Now, if you're living in one of the startup hotspots, then it usually is going to networking events, immersing in the ecosystem, knowing other founders. By the way, don't be a transactional asshole. Like, I have to say it like that. Like, if you only go into an ecosystem when you need something from the ecosystem, you probably won't get far. You have to give a lot to get something back. And for that reason, you also should connect and immerse yourself with other founders. Not only will they help you with viable lessons that they learned themselves to prevent you from maybe making the same mistakes, but they might also connect you with people if they like you. So splurge in the ecosystem, prepare to give something to the ecosystem and not only take from it. So that's step number one. Step number two, if you don't live where the ecosystem is, if you're really serious about building a startup, you might want to consider moving to an ecosystem that has a densely knit network of founders, investors, because venture capital is a relationship business. It just is that way. Like, yes, it is financially driven, and yes, there are some analytical facts to it, but usually in early stages specifically, it's more of an art than a science, and it's a lot about people. You invest in founders, you invest in the founding team if you're an early stage investor.
Good.
And the only way to really get a read on a founder or founding team is by actually interacting with them. So that's where usually these warm intros and like these terms that you see hover around everywhere come from. But don't be fooled, even with warm intros, it's a brutal market, right? Like, the venture game is a game of probability, and it's a game of outliers if you run a fund. So you definitely have higher chances of hearing a no than a yes if you approach an investor. So that's just a reality. Don't be discouraged by that. Keep building, be resilient. And ideally, if you hear a no, maybe ask why, because maybe you get some good insights into what you have to improve to maybe turn some no's into yeses. But generally, what you should avoid, there's two ways. The warm intro that we spoke about, what you should do, we also spoke about to get those warm intros, right? But if you're doing cold outreach, generally everyone would discourage you from just doing cold outreach and relying on it, because your chances of getting a no are even higher than with warm intros. But if you're doing it, maybe some basic tips of not annoying founders with like, let's say, the first investors with the first message. One, if you're doing it on LinkedIn, starting with a little bit of praise, good faith, that usually might work well. You only have a limited amount of characters in your first LinkedIn message, so maybe don't start immediately selling shit to people with your first message. So that's a general rule of thumb in life. If you approach a stranger, don't just focus on selling them their shit. Like, no one likes that. I mean, come on, like, you don't even like that yourself, right? Like, so why would you do that to someone else? Another big no-no, especially on LinkedIn, is coming into the conversation with like this great, I love what you're doing, synergetical, have a conversation. And it's always the same shit. Like, you get that message, wait for a day, and then one day later, you basically get this text vomiting message that basically has like a full paragraph full of, we're building this, we're looking for capital, it's so amazing. Yeah. And unfortunately, 80% of the time, it's completely off thesis. It's absolutely, like, at least in my case, it's something that is absolutely not relevant for me.
They did no research behind the person they've just networked towards. Yeah, this is a big issue in this market.
Thank you. That was like, I was trying to segue into exactly that. Like, if you don't know the other person, at least do a minimum amount of research about that person and find out what they're looking into. And that also applies for face-to-face. So another big no-no, and I actually just recently posted about that because I genuinely want to help founders like not do that, because first impressions matter, let's face it, right? It is sort of like dating. So if you completely mess up the first impression, you might just not get a second chance. That's the unfortunate reality. And if you meet someone face to face in person, try to be charming. Like it's sort of like a game of seduction almost, right? Like, because you are trying to sell something, you're trying to sell your startup, and you don't do that by just shoving it down people's throat, hoping that they don't suffocate on it. You do it by actually finding out why they might be interested in hearing more about your startup. And I think one of the first questions that you can do at networking events, if you are like meeting an investor, actually ask them about their interests. Maybe even ask them a personal question, like just be a normal human being that tries to have a conversation with another human being, and like not cut straight to like business and just be completely transactional.
Mm.
The worst thing that can happen to you, and I've had this on a couple of occasions, is So here's really the worst case scenario, right? So I'm creating a story that includes all the things you should avoid. So people are talking at a network event. First, you interrupt the conversation. You just burst in. Secondly, you don't even care about what the person does. You don't even ask them any question. You just immediately start vomiting your startup pitch into their face. And you do a 5-minute monologue without any pause. And after that 5-minute monologue, you wait for a reaction. And at that point, the reaction might very well be, sorry, this is just not an area that is interesting for me, right? Like, it's completely different vertical, wrong stage. Can be a couple of reasons that disqualify a startup right from the get-go. And there's nothing personal in that. Also, for us, don't take that personal. It's not against you as a person, but like, investors have to focus on a specific vertical, stage, area, whatever. They can't invest in everything, right? Because you can't be an expert at everything.
Yeah.
And then after those 5 minutes, when you finally have a chance to have a dialogue, you maybe tell them in a nice way, sorry, this is just not for me. Really appreciate it. Great job. Maybe you should talk to this person. Usually you try to be helpful and like direct them to someone else that might be interested or where it might be relevant. The worst thing that it can do if that happens is you just one-up it and say like, well, but maybe I can twist it around so that it's relevant for you. And that happens actually pretty frequently, right? They sort of like try to then spin a narrative around their startup that makes it appealing to you, even though you just told them it's really not relevant for me. That's bad, because it's also not good use of your own time. And it might actually annoy the other person even more. But it
also looks bad on you, right? Like, I mean, you're selling without data, and if you sell without data, that's one thing, but then selling and like changing your narrative, the narrative that you believe in order to get money, that's kind of like selling yourself out.
Yeah.
To get money. It will never, even if it works in the short term, it will never work in the long term, because it's not building the relationship, right? Like,
I would totally agree. I would say it doesn't work at all, because you're showing zero conviction in your idea. Like, it's just like, oh no, it does this, it does what you want. Like, oh man. Like,
wait, it really doesn't OnlyFans for hamsters? Wow, that's amazing. Like, that's exactly what I wanted to start. Like, Series B, wow, amazing.
So to summarize, it's don't be a taker, build a karma bank, add, bring value, engross yourself in an ecosystem. If you're really serious about it and you have the capability, move closer to an ecosystem so you can up your frequency of exposure to it. Invert and think about all the things you don't like when people are trying to sell you something, and do not do those things. And stick to your guns. Like, you will get a lot of no's. I think there's an article I read recently by YC, which was, on average, you're going to get 77 no's before you get a yes, just to make it real, tangible. 77 no's. That's 77, if you're lucky, 15 to 20 minute meetings for a no. And to Sebastian's point, ask why. Every interaction is an opportunity to learn why. Don't lose that opportunity. And Sebastian, investor relationships are how much longer than marriages? Do we have the figures?
Yeah, I mean, let's just say you're really going in early stage, right? So you probably stay connected with your investor for at least 5 to 7 years. Now we could be funny and look up how long the average marriage is in the US, but it must be shorter than that.
I'm pretty sure the last 10 years that average was dropped steeply. So in
the interest of time, number 5, we're gonna talk about cap table management. So if we were gonna quick fire, how should early stage startups manage their cap table, particularly when planning for multiple rounds of funding?
Number 1, get an expert. Get someone who's done this before, who has experience and who can tell you the ins and outs. Number 2, don't get over diluted. I think we touched upon that already. You want to stay motivated. Number 3, don't create any weird provisions that are out of whack because they will definitely not bode well with any future investors. Keep it clean, keep it simple. And lastly, don't have too many investors on there. People argue back and forth on that, but general rule of thumb, if you have a lot of small checks, maybe pool them as a syndicate to just keep your cap table clean and not have a rave party going on your cap table with 500 people.
Very nice. Very nice.
That.
Okay, question 6, exit strategies. What exit strategies should be considered while you're structuring your financial terms in the beginning phases of the startup?
Are we talking crypto or equity?
We're talking like emerging tech, so crypto or AI.
Okay.
I was going to say both I think are valuable for our listeners.
Okay, so for the record, a rug pull is not a valid exit strategy.
Oh, shit. There goes my business idea. Exit strategy. I thought it was a business idea.
Well, just want to put that out there. Reality is the absolute vast majority of companies of startups exit via acquisition. So to the order of 80-90%. More than 90%. Way more. Only 1 or 2% actually make it to IPO because not every startup has the magnitude of doing that. And honestly, if you're a first-time founder, you should just make up your rough mind how an exit could look like, but honestly, don't waste time reminiscing about that because, first of all, there is no guarantee. And second, honestly, it's also not that sexy if you raise your pre-seed round to come in and say, we're going to exit the company in the next 5 years with this, and this is going to be the person acquiring us. It just really raises a lot of eyebrows when you think you already have your exit figured out before even getting your first customer. So maybe focus on creating revenue first and then worry about exit. So it's general rule of thumb. But that being said, at least have it somewhere in the back of your mind and have some sort of vision or acknowledgement that if you raise venture capital, investors require an exit. So you at least should understand what they are longing for to actually make an investment.
Mm-hmm. That's a really salient point. Understand who you're getting into bed with. Also understand their investment horizon, meaning how long has that fund been going for? Usually a fund, on average, 5 years, 3 years if they're Web3. Averages, do your research. But if they're 2 years into a 3-year cycle, likelihood is they're probably going to want to see money sooner than later.
Correct.
All right, so question 7, protecting interests. How can founders protect their interest and maintain control? And what are the gotchas when negotiating with venture capitalists?
In general, only raise the money that you need. Honestly, don't over-raise. The biggest caveat or the biggest fallacy I've seen over the last couple of years in startup world and venture capital, people treat raising money as a goal of a startup. It's not. Literally, it's not. Your goal is to build a successful, profitable business over time, and you need capital to do that. So getting capital is a means to a goal. It's not your goal. So don't over-glamorize your closing of your round. Sure, shoot out that LinkedIn post or whatever it is that makes you happy and brag a little bit about it. It's a great accomplishment, but it's not the goal of your company. So don't see it as one, and really only raise the capital that you need to get to the next stage, whatever that stage is. So that already protects your interest, because now you don't over leverage on debt, because while we are talking about equity investments, think of the investment that you get as debt. You still owe the people shares and you still owe them a part of your company. It's just a different form of debt, really. So the easiest way to protect your interest is to only give as little away as possible and only raise the money that you need. And then there's a lot of details in how to structure your cap table and your term sheets to actually protect your interest on an operational layer. But we go into that in our blogs.
On the blog. All right, cool. So number 8, milestones and funding. What milestones are critical to secure before you approach investors for pre-seed, seed? And how do these influence the terms set in the financial agreements? Like, we're talking traction kind of numbers.
So what I can only recommend here, because we could go into so many details right now, and the milestones really depend on the vertical you're in. So B2B SaaS has different milestones than deep tech, has different milestones than a B2C marketplace, has different milestones than Web3. But generally, think of all metrics that resemble traction. That usually the number one is revenue or profitability, right? So there is specific, let's say, revenue ranges that are expected. Let's just say for a B2B SaaS seed round, usually you should be hovering somewhere around $500,000 to $1.5 million in ARR, annual recurring revenue, and you also should show that you're growing constantly. So another factor is how fast does that grow. So there's like this usually like triple, double, stuff like that. So basically, you want to show that you are on a growth trajectory, and then there's other things like capital efficiency, churn rates, your capital burn, yada, yada, yada. So there is a plethora of metrics that can be measured, and the actual milestones that are expected per stage really vary by the actual type of startup we're talking about. So Web3, for example, it can be the TVL, right? Like the transaction value that you see if it's like an infrastructure play, can be the number of users, like the wallets that are connected, things like that. So you should really educate yourself about your specific vertical and see what other companies have achieved. And honestly, there is great content out there, so there is no excuse for you to not do that. And it's actually not taking that much out of your time to like just go down for a day and like do the research to find out recently what were rounds that people got invested in, what were like the typical milestones that they reached. Just as an example, for deep tech, it's a lot about IP defensibility lab research, right? So it's completely different than the typical B2B SaaS play, for example. So educate yourself. There is plenty of information out there. I can only recommend Google keywords, metrics for startup fundraising, metrics per round, what's like the typical benchmark numbers for each startup round, right? So there is a couple of keywords that you can search for that will help you find those out rather quickly.
And we'll follow up on the blog. Okay.
I feel that somebody's pitching very heavily for the blogs that are to come. I'm hyped now.
Yeah, I mean, we're going to stick that HSBC stuff on there. We're going to really try and collaborate with Sebastian to really try and create that roadmap.
Yep.
So because it's longer than an hour conversation, right? So 9, investor relations. We talked about this at length in the pre-call. How people just get this wrong. Like, what strategies should founders employ to effectively manage these relationships with investors? As an investor, what do you want to see? Like when you've already awarded some capital?
I think there's 2 easy tips here. Again, a lot more that we can follow up on, but the 2 low-hanging fruits are update your investors. Like, you wouldn't believe how many startups actually fail on that, and basically go completely radio silent and ghost their investors. Don't be one of them. Yeah. It actually doesn't take that much to do a monthly update for your investors. And you should actually do that yourself to also keep track of your own progress with your team and everything. So you don't have to do an extra update. Just do whatever you do to actually steer your team and steer your startup, right? And just share that once a month. That already can make a big difference and create a lot of trust and confidence. And with that, you can also formulate concrete asks. Like if you need intros, if you need specific things from your investors, then use that regular update to ask them. And it's easier to ask an investor if you keep them in the knowing than to ask them if you went radio silent for 6 months and then out of a sudden resurface wanting something from them. Usually that doesn't go that well because they actually might have forgotten you at that point since they probably have 20 other portfolio companies that they have to cater to, and those companies might have been more active in keeping in touch with their investors. So just bear that in mind. And other than that, it's like, it's about confidence and trust. It's about keeping rapport open, and also like being transparent with like your traction and like, pointing out problems like that. That can be on an ad hoc basis. It doesn't have to be regular updates. But generally speaking, treat your investor like an extended team member. Careful. Don't expect them to do operational work. They are not hired. Like they won't do your marketing strategy for you. But if you have a pressing question where they might have experience or a network, ask them.
Yeah, I think that's very often overlooked. People think, I have investors, so I shouldn't come with my problems and challenges. It's like, no, you should. Like that's why these people are generally strategic investments. Sometimes it's just a check, but often it's actual strategic investment. So you can go to these people and say like, hey, you are an expert in this particular vertical. Give me some perspective on this problem that I have, and because I can't seem to solve it X, Y, and Z. And more often than not, they will say like, we solved that 20 years ago by doing X, Y, and Z. You should probably try this. Or, hey, I know somebody that can help you. Let's connect you and let's get this out of the way.
Exactly.
Be open, be there. Don't be afraid, I think, also of your investors, because it's very often they're like, yeah, but they invest a lot of money in us. Yes, they want to see you succeed. So that means that they're really, really there to help you and not just to, like point you down and say like, oh, you're a complete asshole. Like, yeah, you're really shit at your job. No, you're a founder. Of course you make mistakes, but these people are here to help you, right? But to the extent, like they won't do operational work for you.
Yeah, general rule of thumb, investors generally try to not make their investment go to shit. So you can leverage their intrinsic motivation of seeing you succeed.
Well said.
All right, so this is the last one, and I think it's one of the springboards really into a very brief brainstorming session, depending on how much more time you've got, Sebastian, but future-proofing. And this is where, when I've sat in these tables, it's where we get interested. We're really starting to, you understand your vertical, you understand the vector to the market. But emerging technology is rapidly changing, and you've got to have, where I get excited is an innovative business model. But the term that everybody uses is moats, right? So what are some of the frequent moats, the frequent business models that you're seeing in the space right now? Are there any frameworks that we can just, list off 1, 2, 3 that are investable, that are hot right now, that are things people should look at?
I might have an unpopular opinion on that, and I don't know if that is like general consensus among the VC community, but it's my opinion. So unless you are in deep tech, where technological modes are still absolutely relevant, so IP, trademarks, like you have technology that others don't have, simply put, in like hardware, but also could be blockchain, but blockchain is a bit hard because most of it is open source, and IP in open source is usually tough. Same applies to AI for some part. Mm-hmm. Honestly, I personally think right now we are moving to this point where the distribution mode will be the most important mode. And the reason being is, back then you also had brand modes, you had sales mode, stuff like that, all of that, and technological mode and software as well. I think that I see that vanishing more and more. Why is that? Is because we are in a more fast-paced society right now. The speed and velocity of technological change is absolutely crazy. So if you have a small innovation in a Gen AI application layer solution, chances are that technological mode might actually not be there in 6 months anymore, because the foundational models and the underlying technology has advanced so quickly. And the other thing is, I don't I don't know if people are still that much into brand loyalty. Honestly, I sometimes really question if that still is a thing. Having a strong brand never hurts, don't get me wrong, but I don't know if I would still consider that a real moat. Reason being is you can just be overtaken left and right, and the biggest and strongest moat these days that I see is distribution. Like, can you ship your product to the customer quickly? Like, do you have the network, the channels to immediately reach your target audience and then that's one of the reasons why personal brands and social media have become even more important, because a lot of people use exactly that as sales channels for their products. Now, most of them are like consulting services and typical entrepreneur stuff, and people sling their courses and like their educational content. Fine, that's usually not startup, that's like consultancy work, I would call it. But that being said, right now, I would argue that's the strongest mode you can have. If you don't have, and on the flip side, if you don't have a distribution mode, you're going to have a hard time actually surviving as a startup.
That was an excellent answer. Lots to think about there. Cool.
Well, yeah, it's so like, you know, one of our brainstorm points was like, how do you retain that? Like, first off, valuable, like how valuable is it? And I think we just discussed that, but then how you retain it, right? Like definitely in a fast moving pace, as we are in this industry, both blockchain and AI, is distribution enough? Or got the game harder? Because there's the other side of it where, okay, you have distribution, you are being like you have first mover advantage sometimes, which is great. If you're being taken over, what's next, right? Like if you didn't build out your brand fast enough or strong enough, or your sales or everything else, like it's I think it's a really tough balance at this point, right? Because everything moves so fast in this industry. It goes from literally, like you mentioned it earlier, like meme coins, right? There's no value of it, and it took the industry by storm. Right? There's a lot of theories why, and you know, people are bored and et cetera, but it happened anyway. While there's a lot of very, very strong brands out there that hold it, most likely meme coins won't survive, right? Although Shiba Inu just like I found that out a couple of weeks ago because one of our clients is building on it, moved into Shibarium. They actually have an ecosystem right now. I had no idea. How did they start? You know, as a trashy, no value token, right? So I think they had distribution and now they have brand loyalty. So there is like how do you retain that? That's a really hard piece that I see our clients sometimes struggle with. They're like, yeah, but our distribution is great or our technology is great, but how do we retain those users in the next, well, I normally would say 2 to 5 years, but in our industry, definitely when it's a bull run, it's like 6 to 12 months, 6 to 18 months, right? I don't have an answer. I'm very curious. Like, I don't know how you guys look at this, because for me, it's I think the current landscape that we're in, and maybe it's because we're insiders, I would not start a startup in this landscape because it's so tough. Me personally, right? Like I'm not saying that. I think a lot of people should.
I mean, there's two good things about this. So you actually just mentioned it. The way you retain that is by building strong communities and eliciting strong network effects that, one, reinforce your revenues by recommendations, word of mouth, and basically your users becoming your fans and attracting even more users by sharing it, engaging, and like basically becoming like brand advocates. And networks create lock-in effects, right? So if you start building on one network, you most likely won't shift after 6 months because the switching cost would be too high. So it sort of like also creates a natural lock-in. The other good thing is that while Gen AI creates so much noise and moves so fast, which makes it hard to sustain a lot of competitive advantages or modes, it also enables you to be a lot more efficient in building. So I think and Sam Altman said that we will see unicorns with one person, like one founder, one person unicorns. I disagree with that statement personally, not because I want to disagree with Sam, but I feel like there is more to building a long-lasting company than just having a product that is then like basically developed, driven, and whatever by AI. But maybe I'm just too short-sighted on that one. Point being, though, is he has a very valid point in that companies can run a lot leaner and more efficient and faster, supported by AI agents and by automating tedious tasks that didn't really contribute to the core value of a product using AI. And I think that's a strong narrative, and maybe partly one of the reasons why we're seeing these mass layoffs in tech right now, because sort of like even the big hyperscalers are preparing for that moment, right?
Yeah. My take is if everything's moving towards automation, lean the other way. Your edge is the other way. It's the other direction. So it's no longer manpower. I don't have more men in my army. That doesn't matter anymore. What matters is then quality people that can then activate on what it is you're doing. So bigger karma bank, deliver more value to your community, generate more goodwill, put your face out there and help more people genuinely get involved and give of yourself to help people succeed. That's where I think the edge is. Like, what value is your product actually bringing? And then, of course, speed. I think it's a fast market. Be fast. I think is the other thing. I think Sebastian had a great point. Switching costs.
Yeah.
Churn, whatever nomenclature you want to use, are really low, right? There's no longer just Netflix. There's Disney Plus, there's Paramount, there's HBO. What do I want to watch right now? Okay, it's on Amazon Prime. I'm going to buy that for $5. It's the same sort of thing. You now have options in a world where you had to have massive infrastructure to build a project, whereas now call someone up like Thomas to build a POV rapidly, and you've got a product. It's like you're ultimately you're trying to find the edge. So I think it's have a great team of people behind you who are helping you back that. Your network and their network, if you genuinely help them, these things compound. Have a karma bank of people that, referring back to episode 1 when we were talking to we were talking to Tim, karma bank, do enough good in the world, some good will come back to you, hopefully. And genuinely network as much as you can. I always refer back to the old school stuff. Maybe that's because I'm old, short-sighted.
You're not that old, Charlie.
Yeah. I was going to say old-sighted, but that didn't quite work, but short-sighted, right? To me, I think that's where I think people have to remember, even though AI can do stuff quickly, is you haven't spent 15 years learning how to be an accountant. You haven't spent 15 years learning how to be a lawyer, 15, 20 years at the top of the game. Sure, you can write some prompts, but you still got to know the question to ask it.
Yeah.
You're not going to be able to learn all of the stuff that you're going to need to know. You're going to need to know what the questions are for it to generate something.
And that's, I think, the point, because I think it's the layers in between the expertise that AI is really good at making efficient and actually retain value, right? So at my previous company, these guys built an I don't know, really, really great AI solution, and you should check it out. Actually, I don't think you can, because it's mostly, I think they're mostly using it internal. But it was for building project plans and sales plans for projects, leads that came in, and how they built the agents in the back end was they saved I think 2-3 weeks of sales just by utilizing the right agents, which is super valuable. What was the agent writing the project plans? No, but it was getting all the information and summarizing it so that a human that was an expert actually could write these project plans better. And I think that is value. But to both of your points, and maybe I'm playing a little bit devil's advocate, I think community is super important in retaining that value. But if you look at AI, it doesn't have communities, right? So Gen AI doesn't have communities. Old school data science doesn't have communities. It has customers. And even if you have communities in emerging tech like blockchain, most likely, and I'm maybe just saying something, and the listeners can just attack me on this one, but I think that the value that your community brings is adoption in your industry, with your users, but it doesn't get you to paying customers. I have a theory that most crypto enthusiasts are not using not using the products that they're looking at it. They're hyped for a company for the tech, but they're not always using it. And Liam, if you're listening to this, Liam, our co-host, he is using all the new tech, which is really, really great. But I think that he is at a disadvantage. Like, most users are not like him. They're most likely more like us three, right? Yes, we use MetaMask. Why do we use MetaMask? Because we want to buy, a token, right? Do we really care about consensus? No. Is there a community around MetaMask? Probably. Will they bring more partnerships in? Probably not. Do they count for the numbers that bring more partnership? Yes. So it's a bit like, what I'm trying to say here is that on one hand you have an industry that has a large community but has never, I think, fully adopted a mainstream or mass adoption. And I'm not saying it's not coming. I think it's definitely coming. On the other hand, you have Gen AI that very quickly got into mainstream adoption, and obviously it got commercialized really quickly over the last 2 years, like 2-3 years. And of course, AI is here for a long time with no community. So, and then on both sides, how do you retain that value? Because on the crypto side, I think there's a lot of value that's not properly coming out, and on the AI side, I think there's a lot of value that's coming out, but that's not going to be valuable in the next 6 months because the first mover advantage is sometimes I think not even existing in Gen AI land because it moves so fast. So where do you sit? Where do you go in this landscape, right? Like, and again, devil's advocate, right? So you just might say, Thomas, you're talking out of your ass right now. You should stop talking right now. But that's my perspective.
I think Charlie and I were both waiting for the right moment to say that. No, I'm just kidding.
Yeah. Worth it.
You totally worth it. Now you got a great point there. While I wouldn't necessarily agree with all those statements, there's a lot of valid points in there, and there's a couple of interesting points as well when you compare Gen AI to crypto and in hype cycles. So usually what you see a bubble expanding, and yes, I called it a bubble. Crucify me for it. But usually what happens after the bubble bursts, you see contraction of the industry, and then you see this steady productivity growth. Same thing happened with the internet, .com bubble. Same thing happened in the crypto industry, 2017. I remember there was literally a new Ethereum killer coming out every week, right? None of them actually managed to live up to that claim, but it's the same with Gen AI. Realistically, large language models, there was a new GPT killer coming out last year pretty much every month, right? We have this great new infrastructure. Look where they are right now. But I think on the large language model side, we now see the contraction of closed source and open source, and we're going to reach that plateau of productivity. We are not there yet with Gen AI apps. I think that is way too bloated, and quite frankly, unfortunately, crypto got into this bloated state again. I don't have the numbers right now. I didn't check it before this call, but I think we have over 20,000 different crypto tokens. So
it's still around that same time of a number. Like it always kind of contracts and then expands back to 22K, something like that.
Yeah, and that's way too much, because I would agree. I would argue that probably 90%, 95% of them absolutely do not have a sustainable business model. Again, crucify me for that statement, but just the last 7 years have shown me that a lot of them live on their community and the tribalism, which is great. Great to have strong community, but you are absolutely right. You have to be able to create that jump from the community to real customers, and customers also have to come without the community. While your community can help you find customers and can bring down your customer acquisition costs, still, your product will only succeed and survive if you are able to attract customers outside of your community. Because at some point, otherwise, your customer base will be very limited, and it's going to be hard to expand further. And if I think about it, you made a very good point there. If I think about the products that I'm using day in, day out, I like Android. I have a Samsung smartphone. For work, I use an iPhone. I use them every day. I'm a happy user of the products. Am I active in any of those communities? Absolutely not. And like same thing with ChatGPT. Actually, there I am active in the community. I'm building my own GPTs. I'm like looking into the developer forums all the time. But there is an interesting dynamic there too. Did you know that we have like over 3 million GPTs at this point, right? Like this marketplace of ChatGPT, there's over 3 million right now. And I took fun in like reverse engineering some of them and like going in and basically like prompt injecting them to like see the instructions. 90 to 95% of them are shit coins in crypto terms. Like they literally have instructions that are like 5 sentences that literally all of us could do in like 5 to 10 minutes if we like put our mind to like creating this GPT.
Yeah.
So there's literally no USP, no mode, no nothing. Yet they are still number one in the GPT store for their respective verticals. So it begs the question, why, right? Brings me back to distribution mode, because they figured out an extremely smart way to position their GPT and get everyone to use it.
Yeah.
But then once again, like, I'm very curious to see, okay, they will probably be there for the next 3 months. But what after those next 3 months? Like, right? Like, this is where how fast it goes.
This is where I go, Thomas. So the community piece, I think, is where you instill loyalty and brand. And that's where, so you have the initial value that you provide the customer, which is positioned correctly to bring them in.
True.
But if they're just a transactional buy, like I can buy bread, I won't use the English ones because I can't pronounce the Portuguese ones, but I can get like Tesco, Sainsbury's, Morrison's, Lidl, Aldi. I can buy bread at all these places.
Yeah.
But the one close to my house is Sainsbury's. And I like the cookies that they sell better than the ones at Aldi. Right? And then you start to like, actually, I quite like the bakery there. I quite like their gas is a little bit cheaper. Well, and then you get into I've now got points.
Yeah, that's a flywheel.
I spent $3,000 on petrol, so I get the tier of points that make the petrol 10 to 15 cents cheaper. And that's community. That's what I think. You've got that leverage. I mean, on the balance sheet, they call that goodwill, right? Like you've got that element of special sauce that says, I'm going to go to Sainsbury's. I'm going to go to AI product here that I identify with. And to add something spicy, I genuinely think we're in an age of identity for the obvious hype reasons, but also I really like a specific director. I really like a specific show. Like I identify with that. And I think we're, from the marketing point of view, going into like I use this suite of tools might be the extension to that, or where that community piece is going. It's just putting it out there in the ether.
It's interesting that you're saying this, and coming back to your loyalty card point, there is a community around like an Aldi but do they know each other? No. Do they communicate with each other? Most likely not, but they all use the same loyalty. They're all loyal to the same brand, which is also, are supermarkets the infrastructure of society? Probably.
No, I mean, I was using the loyalty that like everyone knows.
But to your point, like, so, you have the crypto communities where everybody speaks to each other. And I think the retention of value of an Aldi or like a loyalty cards of supermarkets is super valid. Like you go back because you get something, right?
It's a metaphor for a value system that could be created around.
Exactly. Is there anything like that in crypto communities within blockchain, right? Like, are there loyalty card systems?
People are trying it now.
But not like, the actual loyalty card, but like what as you said, like, okay, you're blockchain A and you do DeFi, you do GameFi, you do like, there's no chain that does all of it and keeps all the people there. And that was been my biggest issue. That I think we always said we need an aggregation of all these things, so we can just, you don't need 20,000 chains. You need, I don't know, 100 maybe, right? But how do you get these customers into the supermarket model where they don't need to talk to each other? Again, my mom needs to start using blockchain at some point, right? Like that's the mass adoption we're all talking about. She don't needs to go into a community and figure things out. No, she just gets a loyalty card and she goes go to GameFi, go to DeFi, go to SocialFi, like whatever fi it is, right? Like without, so that transition, I think, retains value of what starts as, I think, an early stage community. And to your point, Charlie, and loyalty cards kind of the highest tier of loyalty, because you don't need that community that talks to each other anymore, right?
Well,
but early stage blockchains, you do.
I think that's the moat. Like,
yeah,
like to expand or metaphorically explain what to add to what Sebastian was saying. That's where I think you have brand loyalty. Like, for example, Nike. There's no reason those shoes could cost 150 other than the fact it's got a Nike tick on it.
That's not true, Charlie.
They cost $8 to $12 to manufacture.
Yep.
And then, the rest of the budget goes into the store, shop fit out.
Yep.
It's like really cool music. You remember that perfume they continuously spray as you walk into the, all of that kind of stuff is where the other $100 goes. But I think it's that is where you're going to start to see technology businesses doing the same sort of thing.
Yeah.
Is kind of where I'm taking it.
To your question, Thomas, like where does that come in with Web3, this loyalty system, right? I think actually, like at the moment, how it is, your wallets and your platforms within an ecosystem are sort of like this loyalty card, but unfortunately not in a good way. The only reason that they are that is because the friction and the switching costs are so high, right? Like, because if, let's say, you engage in a specific ecosystem and you have like you hold token XYZ on a specific chain, you adjusted your tooling to that chain. So you have a wallet for that chain, you have this and that, your sites. So, and since all of that is so involving and time consuming, and this is also for the record, like even for people who have been in that space for 5+ years, this is my cry to founders. For Christ's sake, please, like think more about UI and UX and make it more convenient. If you really want to see like mass adoption, if I have to jump through this like 10-step process to set something up, shit, like, I mean, first of all, no one reads instruction manuals, especially not men. Women are a lot better with that, by the way. We just usually throw them away and then go on this tantrum why things are not working. But like if I have to have an instruction manual to use a software tool, and like have this like 20-step process that I have to follow just to like unlock the value that I want to get out of something, I'm losing interest after step 2, and that's usually when I want to churn, right? And yes, you create a lock-in effect with that, and you retain the community by making it so hard to switch or making it so inconvenient. But that's not a real mode, if you're honest. That's just it's just.
No, that's a vendor lock. That's a vendor lock.
Exactly. Yeah. Thank you.
And I mean, like, and I think that's the hard part of. Well, that's the hard part of crypto. And that's the interesting thing about Gen AI, because Gen AI moves so quick. There is no vendor lock because, I mean, maybe on different LLMs, right? But they will probably have their own ecosystem at some point as well. But it's easier to replicate. Where crypto it loves vendor locks and calls it, no, it's loyalty. It's like, no, it's a vendor lock.
Exactly.
We're gonna get crucified for this one, by the way.
Spicy.
All the maxis will roll out. They're like, like, so we'll dox the hell out of you now. Yeah. So I think retaining value will always change as we move forward. With emerging tech. And I think as a founder, it's really important to understand when to stick to your guns and when to pivot, right? Because your value that was definitely in the bull market, but that was 6 months ago, first mover advantage, might have now been, changed by either the LLM or chain that you're building on. They just took your value and they said, goodbye, you are useless right now.
It is.
Or somebody else just is faster and quicker. So this market, you got to be on edge. But also, if something is good and if something works and you have the traction, don't change it if it's not broken. So it's a really really hard balance to strike. And I'm sometimes glad that I'm a technologist and not in business operations or in venture capital, because it is a really hard world or a hard industry to work in. Definitely in the current market.
I mean, look at what happened with Sora, right? When OpenAI released Sora or announced Sora, they pretty much put 80% of text-to-video startups out of business. And those received quite some considerable funding just like 6 months before that. So there might be one or two survivors that can do something that Sora can't do. But that's just the world we're living in right now. So honestly, one of the biggest questions, if you're building an AI, and I said this before, and I'll say it again, like one of the biggest questions you should ask yourself as a founder is, how big is the risk that one of the foundational model providers will just do my thing, just at scale, a lot easier, and already with 100 million users using that technology, easily switching them over to the new thing, right? Like because that is a real risk. If your solution is too broad, and this is actually like completely contradictory to anything that a VC would normally think about, like you want to have this big TAM, this big addressable market. Right now, like with Gen AI, it's if your market is too broad, there is an extremely high risk of the foundational models just venturing into that application layer that you are building and basically knocking you out before you can even like build up that community that you would need to survive.
Yeah.
And for anyone like sticking with us for this long, like one last nugget that I'm going to drop because I just find it super fascinating. So there was this overview of average time to product market fit of like really known like startups like Canva, Ramp.
I've seen
what
that.
was it? Slack, Figma, like like really well-known unicorn startups that have been around for the last 10 years sometimes.
Mm-hmm.
So the variety was from like 6 months to 4.5 years of product market fit. Average was hovering around 2.5 years.
Mm-hmm.
Now, if you say that you usually have iteration cycles every 2 to 4 weeks, just do the math, how many times you iterate. And I don't know a single founder, and talking with them about their startup when they reach product market fit, that didn't pivot. I would even say you can bet that about 90% of startups don't grow big with the solution that they initially started with. Look at Airbnb and all of them, right? Like, so what that means is, first of all, if you are not willing to let go of your initial concept because you don't see the market responding to it, then you really should consider if you want to be a founder. That's one. But to frame it more positively, if you are resilient enough to stick with it for 2.5 years, going through a lot of bad times and hopefully also a lot of good times, then there is a high chance that you will see this inflection point where people are pulling. There's two things in conjunction with what we just said. One, Gen AI might reduce that time because you might be able to iterate faster and get to the point faster. But secondly, it's also a real question that you should ask yourself: how defensible is the solution that I'm trying to build? Mm-hmm. And can it actually last for the next 2.5 years without being outcompeted or completely replaced, because technology will move so fast that what I'm building right now will not be relevant in 2 years anymore?
Amazing. Yeah, and I think I couldn't agree more. I think the ease of creating the actual piece of technology can also lead to the ease of switching cost.
Yeah.
Not only that, I just agree. Pretty much. Like I was just gonna repeat the same thing. It is exactly that. So this is the point of the show where we're going to switch on to the Desert Island Essentials. Again, if you've listened this far and have enjoyed the nuggets so far, please do like, subscribe, and hit that bell notification icon. It really helps us spread the word. So Desert Island Essentials. This is basically if you were going to if we had a magic button and we could press it and send you back to your early 20s or mid 20s, where you've got no bags, no black book, no special relationships with various different people who have influence in the space. You don't have your current social media and your current following. Basically nothing. You are starting again. What are the 5 things that you would bring with you to that desert island to start your startup?
So framing is starting a startup, right? And for that, the absolute first thing that I would bring is a large notepad and pen, because, and like with large, I mean like really thick, like a lot of pages, because you will probably like have to trash a lot of those pages. But it really helps me scribble and write things down in my thinking process, and I think it's an art that we seem to be losing as AI moves forward. But I think for me, it really helps me. I'd bring ChatGPT or some offline equivalent, because it can just help you in your thinking process and basically get a sounding board for you, right? I mean, as I said, maybe an offline equivalent that is soon to be invented for
Clippy?
it. What's that?
Clippy? Windows, no, obscure Windows 2000 reference where we still had Clippy. No.
Oh God, that Clippy! I actually thought you knew about a new Gen AI tool that I wasn't aware of. Okay.
I wish, man. I really wish.
I think Charles had the same
got a new AI
process.
The day that I'm further ahead with this than you are, Sebastian, I'll let you know.
No, then 2 books that I really like: Lead and Disrupt by Charles O'Reilly, and The Lean Startup. I think that's still relevant.
Yep.
And ultimately, to keep my sanity intact, a soccer ball or any form of ball that you can like play around with, whether that's a basketball, whatever. But soccer ball was the immediate top of mind, because you usually don't really need any additional equipment to juggle it and to do things with it. Reason being is, I think if you build a startup, you really have to take care of yourself as well, and you need the off time, and you should not completely lose track of family, friends, and hobbies, because that's really what keeps you in check mentally, because it will be a lot of frustration, a lot of time, like work time and lifetime spent into it, and so I think you have to compensate that with something that is just pure fun, where it allows you to just shut off your brain for a couple hours.
Nice. I like it.
It's such a red thread, by the way, as well, Charlie. Like we've now interviewed so many people, they all say the same thing.
Take care of your body, take care of your mind. Yeah, switch off. It's amazing. So thank you for being with us on the show, Sebastian. It's been absolutely brilliant to speak to you. We really appreciate having you on. And we've been WT3, the podcast where we tell you what to do next. Sebastian, please tell people where they can find you, where they can get in touch, where they can reach out.
Best place is LinkedIn. Happy to have you in my LinkedIn following, or just send me a message. Reach out to me there. I don't use any other social media, actually. No time for that.
And the blogs that we've been mentioning will also be on LinkedIn, as you have been writing and are writing on a very regular basis about these topics on LinkedIn.
Exactly.
Thomas, you want to sign us off?
All right, well, folks, this is it for today. Episode 7 with Sebastian Spitzer. Thank you. We'll see you for the next guest next week. I'm not going to tell you who it is, but it's going to be great. Don't forget to like, subscribe. And we love it if you repost our content, because we put a lot of heart in this. And we'll see you next week. Thank you.